Hello, good morning, good afternoon. My name is Margaret Biggs, and I am the Matthews Fellow in Global Public Policy at Queen's University. Welcome to the Munk School and Queen's International Institute on Social Policy for 2022. To begin, I would like to acknowledge that Queen's University is situated on the traditional Anishinaabe and Haudenosaunee territory, while the University of Toronto is situated on the traditional land of the Huron-Wendat, the Seneca, and the Mississauga of the Credit. We are very grateful to have the opportunity to live and learn on these lands. For over 25 years, the International Institute has brought together researchers, policymakers, community leaders, and service providers to discuss the most pressing social policy challenges facing Canada and other OECD countries. This year, Queen's University and the Munk School of Global Affairs and Public Policy have joined forces to host an ambitious program focused on whether and how we need to reform or even transform Canadian social policy for a more resilient and successful future. The 2022 Institute launched this past Monday at a day-long conference at the Munk School on the meta challenges and policy choices facing Canada and other OECD countries, socioeconomic, cultural, generational, political. And on Wednesday, we had an extremely stimulating seminar on labor market policy. Today's session on income protection is the second in a series of 9 virtual policy seminars drilling down into major areas of social policy that are most in flux and ripe for rethinking. After the presentations today, we will have a discussion period. So just a heads up that you can send your questions through the Q&A feature at the bottom of your Zoom screen. So now it's my pleasure to introduce our moderator for this session, Miles Korak. Miles is the Stone Center Senior Scholar and Professor of Economics at the Graduate Center at the City University of New York. Miles is also a frequent participant in the International Institute and a friend of the Institute, and we regularly benefit from his advice and expertise. Over to you, Miles.
Thank you so much, Margaret. And my first words are thanks to you and to Keith Banting for bringing us together. I'm really pleased to be here, along with over 300 participants online, to talk about income protection in the United States, the United Kingdom, and of course, Canada. I thought perhaps I'd give each of the panelists 2 or 3 minutes, or 2 or 3 sentences to introduce themselves to you. Janet, would you like to take the floor?
Sure. Thank you, Miles. Hi, I'm Janet Gornick. I am Professor of Political Science and Sociology at the Graduate Center at the City University of New York. I'm also the director of the Stone Center on Socioeconomic Inequality, which is based at our university. And our center includes, among our 6 senior scholars, as you've just heard, Miles Korak. In addition, I've been working with the data archive known as LIST for the last 30 years, including serving as director for a decade. I mention that because those data will form the basis of my presentation, and I'm going to speak about the data in some detail today.
Thank you, Janet. Robert?
Joyce, I'm a researcher and a deputy director at the Institute for Fiscal Studies in London, which is an independent research institute, mostly focused around the microeconomics of public policy. And I run the research team there that deals with the welfare system and with income inequality.
Thank you and welcome. Jennifer, can I give you the floor?
Thank you. I'm Jennifer Robson. I'm an associate professor and program director of the Masters of Political Management at Carleton University, and I'm joining you today from the traditional and unceded territory of the Algonquin. Thank you.
Thank you, Jennifer. So the format for today's hour and a half that we have together will consist firstly of 3 presentations of about 20 odd minutes or so from each of the panelists. Janet will speak first on the United States and other countries in a comparative context. Robert will speak on the UK, and Jennifer will put things in context and give us some feedback on Canada. So these are 3 interesting countries that have a long history of learning and of policy spillovers. So I'm very anxious to talk about labor markets, social policy, and income protection. And without further ado, Janet, can I give you the floor for the next 20 minutes? Janet, I'm afraid you're muted. Janet, you'll have to unmute yourself.
I'm so sorry. I minimized the screen so I could see something and I lost the mute button. Forgive me, and not a good opening there. Thank you so much for inviting me. It's really a pleasure to be here and to be part of this session. And I'm sorry that we're not in person. I love to visit Canada, as I've been able to do many times in recent years. So let me tell you what I'm going to talk about today. I'm going to talk briefly about the approach to redistribution that I'm going to present. Sorry, I just want to set my clock also. That I'm going to present today. I'm going to talk about income protection from a particular perspective. So I want to lay that out just a little bit. I'm going to give a brief discussion of the data, and then I'm going to spend most of my time presenting some empirical results, first on income inequality, and then on the economic status of the middle class defined in a particular way. So let me say what I mean by redistribution and talk about the framework I'm going to use today. The term income protection, of course, the name of our session, can obviously mean many things, and I'm sure that will be evident today. In my view, the term generally encompasses two broad categories. One includes policies and institutions that shape earnings distributions, and we generally assess those in relation to individual workers and potential workers. The other includes public interventions that reshape income distributions that are generated by the market, primarily the labor market. And today I'm going to focus on this second type of income protection. So specifically, I'm going to present findings on the extent to which combinations of taxes paid out and income transfers received by households alter the distribution of income across households. And I focus on households because income, in contrast to earnings, especially when we're talking about taxes and transfers aggregated, that type of income is generally viewed as a household level concept. So what I've said may be entirely obvious, but I did just want to lay it out, and I will make this more concrete in just a few moments. So I'm drawing today heavily on data that come from a data source called the Luxembourg Income Study Database, which is made available from an institute known as LIS, which I think some of you are familiar with. LIS is a cross-national data center located in Luxembourg. So I'm going to take 2 minutes to tell you about the data because I think some of you will be familiar with LIS, as I said, and many of you are familiar with the Canadian data sets that drive the work that I'm showing here today. And I also just want to raise awareness about the data because I think it's very useful for policy and income analyses, and I'm partisan, having worked with the data for so long. So this is what we do and what the data include. A team of data experts in Luxembourg at LIS, they gather data sets based on household surveys, and they harmonize them ex post into a common template to make the data comparable for research across countries and over time, as comparable as possible. They document the data and then make them available to registered researchers around the world via a secure system of remote access to the data. The main value added of LIS is that it allows people to work with the microdata, meaning that we make the records available at the level of persons and households, so we can look very in a lot of detail at what's happening in terms of the income in a household. About 10,000 researchers have used the data since we started in the early 1980s. So LIS was founded in 1983 as a project involving 7 countries with data at a single point in time. So there were 7 data sets. And I'm pausing partly just to note that Canada, thank you, Statistics Canada, has been a core participant since the very beginning. So today there are 2 databases there. One is focused on income data. That's what I'm going to draw on today. And that now includes 650 data sets from 50 countries covering various years since the early 1970s. So that's 650, quite an expansion over the original 7. A second, newer, smaller database focused on wealth, which I'm not going to present from today, though, is also there. And that includes 19 countries at various time points. So I do want to say that the income database now includes 29 data sets from Canada, a big expansion recently. That means we have data sets from Canada from 29 different years since the early 1970s. The wealth database includes 5 data sets. So the income data that you're going to see came from different income sources in Canada over time. For many years, the survey of labor and income dynamics was the source, and now the data are from the Canadian Income Survey. Okay, so let me say a little bit about the framework. As I said, I'm going to begin by reporting income so I want to just make sure you can see the slide here. Great. I want to, sorry, I'm flipping around too much here. Okay. So this is what I'm going to start here with this picture. Let me explain what you're looking at here. So this is a slide reporting income inequality in 2016 for 15 high income countries. So here I use 2 income definitions. The first is household income after taxes and transfers are taken into account. And we refer to that as disposable household income. Those are the dark bars. Disposable income includes income from the labor market and from capital, plus private and mostly public income public and private income transfers, but overwhelmingly public, minus taxes paid out, and that refers to household income taxes and also social contributions paid by workers in the household. The second definition is what is income before taxes and transfers. Those are the lighter bars. And this amount, which is widely referred to as market income, is calculated mechanically by the researcher, in this case by me, by subtracting income transfers received and adding taxes back in to the household income that the survey respondents report. So going forward, just for ease of narration, these terms are kind of a mouthful. I'm going to just refer to disposable income for post-tax and transfer and market income for pre. And if people want to ask them later on about some details, I'd be happy to share those. So just a couple of other things, a few methodological points here. In my presentation today, I'm limiting analyses entirely to non-elderly households. And I do that to avoid mixing households that blend market income and transfers with those that rely overwhelmingly on the latter. And not that inequality or the income well-being of elderly households is not important, of course it is, but I think that the two groups need to be looked at separately because these stories are very, very different. So what you're looking at here is inequality measured by the widely used Gini coefficient. Most of you are probably familiar with that, but in any case, it's a measure of inequality where a higher value represents a more unequal distribution. For both types of income, I adjust for household size and we weight by persons. So we're reporting the economic status of people based on the households in which they reside. So that's my methods section there. It's worth noting that I'm using a very highly aggregated bundle of taxes and transfers. The upside of that is that it provides a comprehensive result. The downside, and I'll come back to this later, it doesn't highlight the role of individual taxes or individual social programs. It considers them for this analysis as a bundle. Okay, so here we are in 2016. So take a look at disposable income. Those are the dark bars. And again, the inequality of market income are the lighter bars. Looking at the inequality of disposable income, the income that people have at the end of the day, we see that the highest level of inequality is reported in the United States at 0.38 Gini points. And the lowest level is reported in the three Nordic countries, the usual suspects, Finland, Norway, and Denmark, with much lower inequality at about 0.25. Canada's inequality of disposable income is in the middle of the pack, 0.31, just about halfway between the United States and the more egalitarian Nordic cases. When we turn to inequality of market income, which is substantially higher everywhere because altogether, taxes and transfers reduce inequality, a fairly similar story emerges. The US again reports the highest level of inequality, now tied with the UK. However, some other countries shift rank, and the Nordic countries no longer stand out as exceptionally egalitarian, and I'll explain that in just a moment. And Canada, again, falls in the middle of the pack. A key benefit of this analytic framework, simple as it is it allows us to consider the extent to which countries redistribute income via taxation and public income transfers. It's common in this field to consider the difference between these two inequality indicators, the difference between the length of the bars, as a proxy for redistribution, and I have followed suit here today. So 2 of the study countries reduced inequality by as much as 14 or 15 Gini points through the taxes and transfers, that's Finland and Denmark, whereas 5 countries reduced inequality by considerably less, about 9 or 10 Gini points, and that includes both Canada and the US, as well as Italy, Spain, and Israel. And interestingly, these latter, less redistributive countries started with higher levels of market income inequality. So through this lens, we can see why inequality of disposable income, inequality again that households have at the end of the day, we can see why it's so high in the United States, which is a rather famous finding, but this is illuminating because now we can see that that's driven by the fact that the market income inequality generated mainly in the labor market, is high and the redistribution is modest, bordering on meager. I'll just take a second to say this pre and post, this is an accounting exercise. We're not taking account of the behavioral changes or demographic changes that we might see if we actually removed the taxes and transfers. So it's really a hypothetical, a thought experiment to some extent. In this picture, I'm using the same 2 indicators. I dropped to 10 countries out of 15 because we don't have comparable market income data in 1985 on a handful of them. We often hear that income inequality has risen in many rich countries. So I put this picture together partly so we can ask, is that true? And if so, has the increase been in income before taxes and transfers or after or both? And our results here, which by the way are consistent with results from OECD and many other databases, we find that here, in this case, I find a common pattern in 8 of the 10 countries, all except for the Netherlands and Israel. we see that inequality rose both before and after accounting for taxes and transfers, and that includes both Canada and the US again. These increases are in the range of quite divergent of 4 to 10 Gini points in market income and 2 to 6 in disposable income. And magnitudes like these are considered to be both statistically significant with data sets of this size and substantial. In all 8 cases, the increase in disposable income inequality was less than the increase with respect to market income, indicating that in all 8 of these cases, again, including the US and Canada, the redistributive mechanisms mitigated the rising inequality generated in the market during this 30-year period. And furthermore, in 7 of those 8 cases, as I'll show you in just a second, the UK is an exception, the magnitude of redistribution itself actually increased between these 2 time periods. So I made this little table just the other day, just to reorganize what I just showed you, to highlight a couple of findings here. So again, these are the same numbers from the previous 2 pictures. In 1985, redistribution is captured in this framework, ranges from 16 Gini points to 6. And in the US and Canada, that value is 8, meaning that's the amount of inequality that's taken away by taxes and transfers, put rather simply. And so the US and Canada are among the least redistributive in this group of high income countries. In 2016, the result is remarkably unchanged, with Canada and the US still they're on the lower end of redistribution. Now that said, in 7 of these countries, including Canada and the US, again, the tax and transfer systems actually became more redistributive during this 30-year period, which is somewhat against the grain of frequently held impressions of widespread welfare state retrenchment. Okay, now I'm going to switch gears a bit and turn to the middle class. There's an enormous amount of research on the poor, and there's been a huge amount of research in recent years on the most affluent, the top 1%, the top 1% of the top 1%, and so forth. I would argue that there's still a dearth of research, a shortage of research on the middle, and it's something that has concerned me and I've worked on for quite a while here. So the ongoing conversation about income inequality has often raised the intertwined question, how is the middle class doing? And across academic disciplines and political and popular discourse as well, a strong middle class is understood to be a necessary condition for robust democracy and a resilient economy. A sizable middle class, many have argued, is required to ensure sustainable levels of public investment in core institutions, public schools, public safety, and so forth. There is no one definition of the middle class among scholars, policymakers, or the general public. And here, and what I'm just about to show you, I chose a definition that's pretty common in the literature. I take the distribution of disposable income as the starting point, and we define households as middle class if their disposable income falls between 50% and 150% of the country's median. So we're not using the term class in a sociological sense, but really more in an economic sense of where households sit in the income distribution. The lower boundary of 50% corresponds to the poverty threshold that's widely used in cross-national research and in many countries. The upper bound, 150%, is largely arbitrary. There is no universal definition of the affluent, but 150% of the median is pretty close to popular perceptions of the meaning of affluence in a number of countries. So let me start by the same 15 countries, taking you back to, once again, to 1985. And so here's this picture. I think is fairly simple to read. It reports the share of these populations that are situated within the middle class, the middle shade of blue. So to the left of the middle class are the shares of persons who are poor in dark blue, poor using the common 50% of the median, country-specific median. The middle, as you can see, of course, is the middle class, and to the right is the share that's calculated to be affluent. In 1985, among these countries, the US reported the smallest middle class. Only 59% of persons, fewer than 2 in 3, lived in a middle class household as defined here. So some 30 years ago, the United States was already home to an unusually small middle class, one that had one that was substantially smaller than many of our neighbors, especially across the Atlantic. And the US middle class was also substantially smaller, and by quite a bit, than the comparable group in Canada, which was ranked 7th, where the middle class constituted nearly 70%. The high-end cases you can see was Finland, where the middle class reached a remarkable 86%. Here's the same picture 30 years later. You can see the pattern of difference there visually. And actually, I was surprised when I saw this. After 30 years, this picture is remarkably unchanged. The result for the United States is nearly identical to 30 years earlier, as you can see, vis-a-vis the size of the middle class. Canada also remains in the middle of the pack. So once again, I just rearranged these two pictures into a third one to summarize the question, to summarize this, is the middle hollowing out. So what has been the trend? Has the middle hollowed out, as we often hear? Is that a widespread pattern? Well, you can see here, the dominant pattern has been one of a shrinking middle class in terms of its size. In 14 out of our 15 countries, the share of the population situated in the middle declined. The exception is Australia, where the middle class grew by 1 percentage point. The magnitude of change was quite varied. In 7 of these countries, the size of the middle fell by about 10%, 8 to 11. In 5 countries, including Canada, it fell by a much more modest 3 to 5 percentage points, 3 in Canada, as you can see. And in 2 countries, the middle class shrank, but very slightly, declining by less than 1%. The overtime result in the US, I want to say, was somewhat unexpected by me and some of my colleagues. The United States is in that last group to which the middle class was nearly stable over 3 decades. It's important to note that this finding is sensitive to the placement of the upper threshold. If you move it up to 200, which can be done and is justifiable, the US middle class fell, but still not by much. In the United States, the stability in the middle class, I would say, though, offers little reason to celebrate, given its exceptionally small size at the start and end of the period. So finally, we can ask, in terms of this picture, where did they go? The middle class, the population that exited the middle class over time, did the portions that exited go up, or did they go down? And to be clear, I mean that in a cross-sectional sense. I'm not tracking individual families. I'm just asking what happened to the population shares over time. And we can answer that by looking at those prior graphs, because we can see as the middle shrinks, we can see, did the poverty share or did the affluent share increase, or both, or how did that work? So what did we see? I'm not going to show you that right now, but just to tell you, there is no single pattern. In 9 of the 14 countries where the middle class shrank by any amount, a larger percentage of persons moved down into poverty than up into affluence. In those cases, the poverty rates increased substantially, sometimes by 4 to 7 percentage points, which is quite a lot. In the other 5 countries, which includes Canada and the US, we see the reverse. A larger share of the population moved up rather than slid down. So let me mention that the size of the middle class, I was surprised, again, that the size of the middle class remained so stable, both because that's at odds with the popular discourse about the declining American middle class, and because of the well-known increase in inequality that unfolded during the same period. My own results showed you earlier that inequality rose and rather substantially during those same years. How do we reconcile this apparent contradiction? The answer is that the overall increase in inequality in the United States was driven mainly by changes among the affluent, changes that arose above the upper threshold of the middle class. Although income inequality increased within all 3 groups, poor, middle class, and affluent, its greatest increase by far was among the affluent. Okay, I'm going to close by showing you one final slide in just a moment. So I want to say 2 things about what I've just shown you about the middle class, which I hope has piqued some thinking or curiosity, interest. One is that I've only spoken about the size of the middle class. I haven't spoken about its economic well-being. In the US, and in my experience, in many places, we hear a lot about the decline or the collapse or the hollowing out or the destruction of the middle class. That's clearly an imprecise bit of rhetoric, which I think is unfortunate. Among other weaknesses, this discourse tends to conflate concerns about the size of the middle class with its level of income. And in fact, that really shouldn't surprise us. So in a number of countries, the size of the middle class fell while its income level rose during the same period of time. But that shouldn't really surprise us, given what I was just saying, that in 9 of the 15 countries, the middle class share fell while the poverty share increased. So those households that remain in the middle are selectively better off. So my point is that I think we need to be cautious when we ask questions about the status of the middle class based on this income framework. The implications of changes to the middle class depend on exactly what we mean. The second thing is these pictures that I just showed you are all post-tax and transfer. They're all disposable income. So actually, when I was speaking with Keith Banting last week about some of these findings, he asked me, what do we know about how the redistribution story affects this? Redistribution affects the middle. Very little has been done on that. So I asked a postdoc in the Stone Center, Manuel Schechtel, who Miles knows as well, a new postdoc who just joined us. He's done some very interesting work on the impact of taxation on poverty. So I asked him to do some analyses, and he did some interesting analysis and produced this picture for me. So I'm going to close on that to say this is what we see here. This graph, it's a little bit counterintuitive, but The graph, he also produced this for a couple of other countries, but I'm just going to show you Canada. The graph presents results from Canada over the last 20 years. Same data, it's almost exactly the same methods. The details are really minor differences. So let me point you to the distinction between the dashed and the solid line. The dashed line is market income, as I've talked about, and the solid line captures disposable income. So in the interest of time, I'm not going to focus on the difference between the blue and the red. Those represent two different household compositions. To illustrate this, so then let me point you to the blue line, though. Those are couple-headed families with children. So just here's how you would read this. In 2015, this means that in Canada, mean average market income among middle-class families, as I've defined them, we've defined them 50 to 150, was equal to about 220% of the poverty line, where the poverty line is half of the Canadian median. Mean disposable income among middle-class families was equal to about 195% of the Canadian poverty line. What that means is that on average, the combination, this very aggregated combination of income taxes and income transfers reduced the income of these families in every year. I think it's fair to say that this is a very broad brush picture, and I think it opens more questions about the status of the middle class than it answers. And in fact, what we plan to do, what I hope to do with my colleagues in New York, is next to disaggregate the middle more finely, say into the lower middle and the upper middle. They look very different. And also to disaggregate the taxes from the transfers, which is a heavy data lift, but can be done. And to the extent that the data allow, to disaggregate the transfers to capture individual income protection programs. So we plan to assess this in various ways in Canada and in other countries, so we can begin to understand how taxes and transfers protect, if you will, versus reduce the income of households whose income places them somewhere in the middle of the income distribution. So I'm going to stop at that.
Thank you very much, Janet. That's a very comprehensive tour de force to begin our mapping of income protection in these countries. I certainly take from this a couple of things. One lesson from the United States, of course, is that inequality fosters entitlement amongst the advantaged. It fosters shame and robs the disadvantaged of dignity. And most importantly, or just as importantly, it also creates insecurity for the broad middle and for other groups. I should point out, of course, as many of the participants in this session are aware, a lot has happened in Canada since 2016. And certainly the pandemic was a major stress test for our income protection programs. In 2020, you saw market-based income inequality shoot up tremendously. But for the first time since the early 1990s, the tax and transfer system completely outdid that, and inequality fell, emphasizing the important role that public policy can play. Along with that, the poverty rate has fallen to unprecedented levels. So this really sort of sets up an idea of, how far can the tax and transfer system go, and how much should we rely on the labor market to equalize things? And I hope we can continue those themes with Robert's presentation of the United Kingdom. But thanks again, Jen. Robert, over to you.
Great, thank you. On my screen.
And we can hear you fine. So I'll ask you to finish up at around just before 10 minutes to the hour.
Brilliant. Fantastic. So thanks for inviting me to this. It's great to be part of this really interesting discussion and great panel. So I'm going to use the UK very much as the running example, as Miles said, but I've basically chosen 4 topics here, which I won't read out, but these are the ones I'm going to cover. And the reason I've selected these 4 is because they all satisfy 2 conditions, I guess. One is, if I had to give you a very high-level description of some of the most important ways in which the UK income protection system has changed in the last quarter century or so, these would be among the ones towards the top. And secondly, I think in each case, there are important challenges posed or links to wider changes in the world of work in each of these cases, many of which will be very common across a number of countries. And I will try and draw out some of those commonalities as I go along. So let's just dive straight in, given time. The first issue I want to talk about is really an extremely high level issue, a very sort of broad brush issue for income protection systems, which is what exactly they're trying to protect against. And I've set this up as, job loss on the one hand versus low earnings on the other. This is taking sort of the working age part of the system as my focus here. Now, of course, in reality, it's not a simple choice like that. You can do both. And indeed, pretty much any developed country system does try to do both. But on some level, there is a question of priorities. And these priorities do change over time in important ways. So what I'm going to do is, first of all, tell you how things have shifted here in the UK case and some of the consequences of that, and then briefly zoom out with some more general reflections on that. So here's the UK situation. This is the percentage of all working age cash transfers, which we tend to call benefits. I know that's not always the term used across the world, but that's what I mean when I say benefits, which go to families that have at least one adult in paid work, as opposed to out of work families. So essentially the punchline is this has risen quite a lot over time. To around half of all of this budget now goes to families with someone in paid work. That's the very big high level shift. Now, there are a few things going on here. One of these is that in the UK, the underlying nature of the population has changed. There are more families in work. The UK has been a story of very sort of jobs-rich labour market, if you like, in recent history, but with an issue of low, rather stagnant earnings levels amongst those who are in work. So part of the shift in what the welfare system is doing is a sort of mechanical consequence of that. There are more families with a job, and so more of the low-income population has a job, and so more of the welfare budget goes to those sorts of people. But it's not just that. It's also some deliberate reprofiling of the system, of what the system is attempting to do and who it is trying to support. This shows you that in some way. This shows you if you split households according to their level of earning, so employment or self-employment income before tax, and you express that as a share of our poverty line. So that ranges from 0, which is out of work households who have no earnings. And then the next row is households who do have someone in work, but with a pretty low earnings level of less than half of the poverty line. And then households between that and the poverty line. And then the bottom row is those above the poverty line in terms of their pre-tax earnings. And for each of those groups, you can see the amount in inflation adjusted terms that on average those households received back in 1994, so 25 years earlier, and then around now, specifically on the eve of the pandemic. And in the right-hand column, I'm just showing you the percentage change in that number. And you can see here the sort of reprofiling effect. The biggest change here, quite comfortably, is for households who do have someone in work, but on a relatively low earnings level, where the amount of support that is targeted towards those sorts of households has gone up a lot, and certainly a lot more than the out-of-work safety net has increased. Now, what's going on here? A big part of what's going on here is our tax credit system, which is quite closely resembles a number of other sort of growing in-work transfer systems around the world, which are designed to top up the earnings of households that, as I say, are in work, but that don't have an income too high to disqualify them from these schemes. And this has been massively expanded in the UK over time. So that's a big part of what's going on. And that's also explaining a big part of the sort of reprofiling of support. And this has had the consequence, I could show you another chart, and I won't for time, of really boosting the incomes of low earning working households. It's certainly had a big effect in holding down rates of in-work poverty, for example, below what they would have been, as you would tend to expect. But the flip side of that is that in the UK case, we have less and less focus in relative terms on an out-of-work safety net. That is not where the focus of any reforms have been really for a long, long time. And as a result, as earnings have grown, at least until more recent years, the safety net relative to earnings levels that people get when they're in work has got lower and lower. And we're extremely low by international standards here. So this shows you replacement rates comparing the UK to the OECD average. So replacement rate here is how much you're entitled to when you're not in work as a fraction of your earnings when you are in work for an average earner in different sorts of families here. And basically here, the UK has been low here for quite a long time. And that's partly because of one piece of important context, which is that we have very little earnings related elements to our system. So what you get when you lose your job bears normally no relation at all to what you were earning before you lost your job. So for anyone on more than very modest earnings, we've often tended to have for some time quite low replacement rates for that reason, particularly compared to countries that do have these more contributory and earnings related systems. But it's got lower and lower over time as well, because it just hasn't been the focus of any changes in our policy. So if you're single without children, on average earnings, and you lose your job, on average in the UK, your income falls by 87%. So huge, obviously a real lack of insurance there. So this has been partly deliberate. We in part knew that we were doing this when the UK expanded, really prioritized expansions in in-work transfers. This was to do with policy objectives, including trying to incentivize more people to move into work, tackling a problem that we very much used to have of workless households, trying to address in-work poverty and child poverty in particular, and increasingly over time responding to a growing problem in the UK, which is low earnings and a large pool of workers with low earnings. But it does mean that the system's changed quite a lot in shape, and it's very, very ill-equipped for dealing with a large-scale jobs shock. So, for example, during COVID, where many sectors were completely shut down for some time, our welfare system had nothing in it that was remotely adequate for dealing with that situation. And as a result, we had to really design a furlough scheme pretty much from scratch, and in a real hurry. And as a result of that, it was rather crude and probably would have been better had it not been designed from scratch in such a hurry. And looking forward, and again zooming out to thinking about other countries, the experience here in terms of how jobs heavy they are and how earnings poor they are, trends there vary quite a lot between countries. The US is, if anything, rather the opposite of the UK, and its problem recently, for example, has been declining labour force participation. I think the general point here is that with things like automation, continued technological change, transitions to net zero carbon emissions, continued changes to trading arrangement, things like all these things that will create structural change in labour markets. I think these shifting sands are going to matter a lot, including how we think about what exactly we are trying to protect against and which problem exactly we're trying to respond to most here. And so in the UK case, we're now very, very ill-equipped to deal with certain sorts of structural changes and recessions, and much better equipped to deal with others as a result of this sort of pattern. Briefly on hours of work as well, this is another big issue, I think. It's often an increasing issue in the sense that there, in many parts of the labour market, there's increasing variability actually in hours, with the fact that there are so many more women, and in particular mothers, in paid employment than there were in decades past. And that's a group who remained very much disproportionately likely to be in part-time work. You can see here a picture from across the OECD, also showing that actually in the UK, that's particularly true, highlighted in the middle. We particularly have a lot of part-time employment amongst mothers for lots of reasons that I won't go into. That's a sort of separate discussion. But part-time work in some ways is an increasingly key element of our modern labour market, actually even amongst men. And I think this is one where the UK is more distinctive, or is particularly distinctive. But even amongst men in the UK, there's been a trend amongst those on the lowest wages. So this is splitting male employees according to their hourly wage level and showing you the percentage who work part-time. And there has been a trend, which perhaps has turned around a little bit in recent years, for more and more of the low wage men as well to be working part-time. So it has been in many ways an increasingly relevant issue in the UK, is how this sort of group of people are treated by the welfare system. Now, there are many reasons for both of the shifts that I've just discussed. It go well beyond the welfare system, very likely. However, one relevant factor definitely is the way that our income protection setup works. There's been a big change in the UK, and I will argue this does reflect general trends that apply in quite a few countries, towards structuring incentives essentially such that part-time work is really heavily encouraged, and often full-time work is encouraged less and less. So let me just show you the fact that that is true, and then I'll talk about why. So here I'm taking a group of low-earning parents, a particularly sort of relevant group here, taken from survey data that we have in the UK, and calculating for each of them their effective marginal tax rate when moving between no work, part-time work, and full-time work. So just to break down what I mean by that, here are the results for 1997 as the tax and transfer system was in 1997 and as the population was back then. So if you take this group of low-earning parents and you look at when they move from doing no work to 20 hours of work per week, how much of their earnings do they lose either through explicit taxation or because they are losing support to income-related transfers when they increase their earnings in that way? And then you do the same exercise for when they move from, broadly speaking, part-time to full-time work, 20 to 40 hours. Essentially, in both cases, the total effective tax rate was about 50%. They kept about half overall of the earnings of the extra earnings they got by doing that. Now, here are the equivalent figures for essentially now. They're pretty different. So the effective tax rate on moving into part-time work has gone down rather a lot, by about a quarter. But the effective tax rate on moving from part-time to full-time work has gone up rather a lot. So what's going on here? Actually, this does largely come back to the big expansions of in-work transfers that I mentioned before. So a lot of this is by design. Certainly the change in the incentives to go from 0 to 20 hours. Our tax credit system, like a number of others, explicitly gives you money once you work a certain number of hours or earn a certain amount of income. So that's why the financial incentive to do that is greater. But equally, because it's income related, we don't give these tax credits to everyone all the way up the income scale. That also means you've got more money to lose potentially if your earnings get, in inverted commas, too high, which can often happen when you go from part-time to full-time work. So this is quite a big change, and it's happened for quite a clear policy-related reason. So my view on this is that, as ever, there are trade-offs. It's a difficult one. You want to support part-time workers on low earnings and full-time workers, ideally. But I think we've learned quite a bit since this sort of system, particularly our expansion of the tax credit system, began in the late 1990s, about the nature of part-time and full-time work, which might give us pause for thought. In particular, it's increasingly clear that, contrary to the initial hope, just nudging people into some form of work, any form of work, tends to do very little long-term in terms of launching their career and getting them started on the career ladder. You don't tend to see any progression at this end of the labour market, rather depressingly. And there's a big difference between the sorts of progression you see and build up in labour market attachment that you see when you compare people who work full-time and part-time. And so I think at the very least, in some sense, if the design was correct originally, given what we knew then given what we've learned since, it's probably not quite right now. So I think there's a good case for just rethinking the balance of incentives that we're providing here, particularly with the sort of longer term career effects in mind. Two more issues, which are going to be each a little briefer. Conditionality. So by this, I mean essentially attaching conditions related to job search, most typically, or job readiness, to the receipt of benefits for those out of work. And this is also a pretty common policy direction in a number of countries, and the UK is definitely included in that. I think there are two questions here. One is, what exactly is this achieving, which I'm going to talk about, and I think one has to be quite careful there. And number two is, how compatible is this, or what are the challenges raised by changes in the nature of work? So let me just say on the first of those issues, we've looked at this quite a bit for the UK recently, particularly exploiting a big change here, which was extending these job search conditions to a much larger group of single parents. So single parents who are out of work used to be able to claim out of work benefits whilst taking no steps to look for work as long as their youngest child was under 16. Now that's only the case if youngest child is under 5. And so we've been able to look at the effect that has had on various things. There's quite a lot of literature on this in general, looking at impact of these sorts of things on employment rate, but we try to take a broader view to get a more holistic sense of what this is achieving. This is results from that. This is basically our estimates of the impact that had on patterns of paid work among the affected single parents. The grey bars showed you the hours of work they were doing at baseline, so without the policy change. So most of them actually work full-time, but part-time work is also pretty common, as you might expect amongst this sort of group of people. But the effect of the policy was basically entirely to increase part-time work. So actually a little bit coming back to a similar theme that I just mentioned earlier with the sort of financial incentive side of things. All it did was increase part-time work at very low hours and very, very low earnings levels. Now, as a result of that, and I won't show you this, but when you look across a range of other outcomes, thinking about what the government might be trying to achieve from this policy, it's quite hard to see what it is achieving. For the people concerned, of course, if they move into work, their income may well go up, but presumably there are other costs to doing that, which is why they weren't doing it in the first place. So it's not clear that it's better, at least in the short term, for them. The gains for the rest of us are negligible, fiscally, mostly because they're earning so little. And actually, they often become entitled to in-work transfers as well as losing entitlement to the out-of-work transfers. So the fiscal gains are really negligible. And it's not really clear that this is helping in some longer-term sense to build better labour market attachment, wage progression, and so on, precisely because of the kinds of work these people are going into. We know from lots of other literature that this sort of work tends not to deliver that. So, I'm not necessarily, there are people who I think are just in principle opposed to any form of conditionality. I'm not one of those people, but I think it does need quite careful justification. When you look really closely, it's not entirely clear what it is achieving. And this is a very common policy direction taken in lots of places. And the other point here is, how does this work in the future world of work, potentially? In a world where, in principle, to put it a bit crudely, anyone could deliver pizza for Deliveroo tomorrow. We might not want them to, but in principle, with this sort of platform-led work, these possibilities are there. What do we even mean by conditionality and having to show that you are seeking work if you're out of work? It's not clear how to actually operationalize the concept. I think at least it gets a lot more complicated. Okay, and last issue, I know I've got only a couple of minutes, and that should be okay. This is around aging. So this is obviously relevant. There's a growing group of older people around the state pension age, and that's true in many, many countries. And in particular, for my purposes here, there's a growing group of people who are just below the state pension age. And that's especially true when state pension ages increase, as they have been in the UK a lot recently. You leave a growing group who are just below that state pension age. And so the issue of how income protection works at around that age is really important. And it's often been, it's often been true in many countries that we tend to give a little more support as a sort of income floor for those of pensioner age than those under pension age. And there are some good reasons why you might want to do that. For one thing, you're not expecting them typically to be able to support themselves through work. But in the UK, at least, this gap has grown hugely. So this is the sort of out of work safety net for the working age population. And this is how it's changed in terms of the sort of equivalent income floor once you hit state pension age. So this is the sort of means tested income floors. So the gap has risen from about 30% to about 130%. A lot of this is to do with, politics. I think it's not controversial to say, and voting power. We don't need to get into it, but this has been a big, big shift. And the consequence is that you've got a growing group just below the state pension age, waiting in some sense for this huge jump in support when they get there. And there is, I think, reason to be quite worried, particularly about the subset of those people who have real reasons why it's difficult for them to work. So I think rethinking things like whether we need a more gradual phasing of support, of the level of support, maybe as you approach state pension age, rather than this sort of huge cliff edge kind of difference, for example, is well worth doing. And my last slide, just to say, this is actually increasingly pressing in the UK at the moment, because in the UK, and this is where we are currently internationally distinctive, we actually have an increase in economic inactivity that is persisting since COVID. So, and 2/3 of that is driven by 50 plus, 50 to 64-year-olds. So there's actually a growing group of these people where the way that we support them really matters. But I will stop there. I think my time is up and pass over.
Robert, thank you so much. Certainly that last slide suggests a ticking time bomb in the UK welfare state. But I think the other thing I took from your presentation, putting aside the very provocative discussion about conditionality, which opens up all sorts of issues on policy design and role for basic income, even at one extreme, was your first discussion about replacement rates and insurance. It strikes me that the first 20 years of this millennia have taught us that big shocks matter. They may be sort of slow and gradual and foreseeable, or they may be sudden and unpredictable. And that's a policy agenda around insurance, one that we're dealing with here in Canada as well. So a lot to talk about, a lot to think about in those two presentations. I'd encourage people attending the session to put their questions in the Q&A. Sherry Torjman, a longtime observer of Canadian social policy, even more than an observer, has already kicked that off with an interesting question that we'll turn to after our discussion after Jennifer's last presentation. One, of course, that I'm very much looking forward to, Jennifer, I'll give you the floor for the next 20 minutes, which is ending a little bit after 10 after the hour, if that's okay.
Thank you, Miles. Thank you. Bear with me while I fumble for the screen sharing.
Fumble is part of the Zoom vernacular.
There we are. All right. Thank you again. I'm really so honored to be part of this conference and to have the chance to be part of this particular conversation, especially with people whose work I've really long admired and certainly recognize a number of the names of the attendees and in the audience. Before I start, I'm afraid that probably will not work if I have that up there. There we are. Before I start, and I just need to say this, given events unfolding in this particular province where I'm joining you from, I'd like to note that given the theme of this particular panel, the right to collective bargaining, including the right to engage in peaceful job action and assembly, has been really critical in making progress on income security in this country and abroad, and it is a right that should be protected and respected. So with that, I will turn more to the substance of my presentation for the day. Miles, you asked me to think about the big and recent challenges from a Canadian perspective in income security that will be with us in the years ahead, as well as the innovations that may have come out of the pandemic income supports and might be worth keeping. And I think, there are going to be many papers to be written about everything that went wrong in Canada's pandemic income supports. I guess I've written one of them at least, but I'll try and keep my remarks today a little bit more forward looking. I'll start with the challenges, and I'm going to be focusing today specifically on income security for working age adults. This is the group that is too old in Canada to be covered by our National Canada Child Benefit and associated provincial benefits, but also too young to be covered by public pensions and seniors benefits either. And the challenges in the existing patchwork system have been well known in this country for years, but the pandemic definitely brought them into stark relief. This is pre-pandemic data for the employment insurance system. This is Canada's, of course, Canada's contributory unemployment insurance program. And what we see is that just 42% of workers who lose their jobs are eligible under existing rules to collect EI benefits. The reasons for non-coverage are multiple. For some, it's the reason that they lost their job. For others, perhaps they were new entrants into the labor market to begin with. For others, still, it's the number of hours that they worked just before being laid off was too low. But really, it's the big share of workers who aren't covered are workers who weren't paying into the system at all and therefore are uninsured. As I said, maybe some of these are new entrants, maybe their work wasn't insurable, for example, self-employed workers. Maybe they've been misclassified as independent contractors or are working with employers who don't play by the rules. Whatever the reason, a little more than a third of people in the workforce who aren't working but are available and looking were not contributing to EI, so cannot get any benefits. At the same time, let me also note that there are about 1.3 million private enterprises in Canada, and about 552,000 of them have no employees on the books. And so even if they are relying on someone else's labor for their activity and profit, they don't pay any premiums into the EI system either. Some, including a lot of my terrific colleagues in the Government of Canada, have argued that our country, like many others, is seeing a progressive unbundling of paid work. So a shift away from paid work as jobs or ideally even lifelong careers to tasks. And of course, the Akroloff-Yellen model reminds us that there are frictions, right, when it comes to matching employers and employees. And unbundling seems to reduce many of those frictions for employers. Digital platforms, for example, have found ways of quantifying things like client satisfaction, work effort, reliability. And so maybe we should, given that, that shift, expect growth in so-called gigs instead of the traditional employer-employee relationship that EI was really built for, maybe. In fact, pre-pandemic, we have seen in Canada, this is data from Statistics Canada, some growth in the gig economy, particularly among women. And maybe this has been side hustles, sort of extra work done on the side as a form of self-insurance in addition to some other primary way of working. But when there's an economic shock, and Miles, you alluded to that earlier, whether it's a global pandemic, a recession, this is part of household income that is not insured. It's not insurable under our current system. And if we allow, or frankly, even implicitly encourage, as we seem to be through other policy mechanisms, I'm thinking, for example, of the current trend amongst registered nurses across this country. If we're implicitly encouraging piecework effectively instead of standard employment, this is going to be a challenge for the parts of household incomes that we think we're really covering in our social insurance systems. And as a matter of fact, this may not necessarily just be about labor law and platform regulation. These other sort of side hustles can come in many forms. This is data that was released earlier this week by Statistics Canada, noting that gig income isn't just about digital platforms or marketplaces. In fact, growing numbers of families have a side gig as a landlord. And this is forming what seems to be an important and growing source of household income in addition to what we might think of as work. So I think it's also important to remember we shouldn't be confusing gig work with self-employment. These two ideas are not necessarily interchangeable. And we should also pay attention to the diversity within self-employed workers. This graph is showing you the trend in two different forms of self-employment in Canada. This is indexed to February 2020, so just before the pandemic hit. The dotted lines are the small business owners. They're incorporated and they're employers. Their numbers are down, yes, but recall that the current system allows them to pay themselves as employees of their own business. And so that means that they have an opportunity to benefit from the collective insurance of the EI system. The solid lines are for the unincorporated self-employed with no employees. Their numbers are also down relative to pre-pandemic. They can opt in to part of the EI system that covers parental and sickness benefits, but just 1% do in any given year. Why? Well, I think actually when you dig a little deeper, it's not that much of a mystery. It's because many of them actually have very low or modest incomes, low enough to qualify for another benefit, the Canada Workers Benefit, which is kind of a wage top-up. It's a bit of Canada's equivalent to the US EITC. I'll say more on that in a moment. Let me add one more angle on this particular challenge of sort of what is it in household incomes that we're trying to ensure. There isn't a clear, bright line always between the people who can kind of pass our standardized 5-point tests to be deemed as employees and get into the job-based insurance system of EI versus those workers who aren't. And here what I'm showing you is data from tax data, as well as the Canadian Income Survey that Janet referenced earlier. And it's different ways of estimating the share of self-employed workers who are paying something into our common pool employment insurance fund, as well as the conditional mean of what those who are paying in are contributing. So you can see it's about 9% of self-employed workers if you only count those workers who make more than half of their income from self-employment, but it's more like 40% of workers if they have any self-employment income at all. So it's clear that many self-employed workers actually have a job and are paying into EI, but the current EI rules will never let them collect if they are laid off from that actual job, that standard job. Why? Because in our system, if you have ongoing self-employment that is anything but very ancillary, then our current system says you aren't unemployed, you aren't available for work. And that's true whether you're making any money in self-employment or not. Let me turn to challenge number 2. In my earlier slides, I illustrated some of the gender differences in gig work trends and in self-employment as well. And here I should note that our current data in Canada make gender diverse people largely invisible. And often we likewise make invisible disability and race considerations as well. We're getting a bit better, but we have a long way to go to be able to actually use national data for intersectional analysis. So yes, today I am focusing on gender as one starting point. And it is a relevant consideration when we think about income security, about who's covered or not by virtue of the kind of paid work that they do, but also what kinds of risks are covered by social insurance. The pandemic had very clear and pronounced impacts on the paid work of women, partly due to occupational segregation and exposure to pandemic-related shocks, and also on parents, more often but not exclusively women, owing to the repeated and persistent interruptions in access to childcare in primary schools. On the left, and this is inspired by previous work by Tammy Sherrill, I'm showing you the trend line in actual hours worked for core age men and women, again, indexed to February 2020. Women took much longer to regain their pre-pandemic hours, their paid hours, that is, compared to men. They experienced another setback in 2021 and do not seem to have fully shared the same kind of growth that men have experienced during this period of tight labor markets. But then did our main income security response, the Canada Emergency Response Benefit, did it manage to reach men and women equally? And the answer seems to be no. Along much of the household income distribution, and I'm showing you this on the right side of the screen, women were much less likely compared to men to collect pandemic benefits. These benefits were quasi-universal. The eligibility criteria were far more inclusive than any income support program for working age adults before or since. And even the types of shocks that were covered, layoff, yes, but also sickness and caregiving were also far more inclusive. And yet this gender gap in take-up remains for women outside of the middle income brackets, and particularly so for women in very low income households. And this challenge of looking at how gender and household income shape access to income support is not new. This is a graph showing you access to maternity or parental benefits, which are a subset of employment insurance, for new parents by family income. And it shows a pretty clear upward trend in the likelihood of a mother or her spouse getting EI maternity or parental benefits as income rises. This was the same trend, by the way, back when I looked at the data first in a 2016 report, and it hasn't changed. So if we care about the social aims of EI as income protection in cases of life events like birth or adoption, then this graph is pointing in the wrong direction. One last slide on the challenge of intersectionality is something that is about, yes, multiple factors or dimensions of how real people interact with systems and their opportunity and impacts, the impacts of public programs. But intersectionality is also about how those real persons are situated inside of complex systems. And in our policy processes, we don't often make enough space to think about the interactions of multidimensional people inside multidimensional and uneven systems and institutions. Canada is a federal system, and some of our income security systems are run federally, and other portions, namely social assistance or welfare, run provincially. It's all for working age adults, but it's not all built with workers in mind. Historically in Canada, when we experience an economic shock, EI responds as well as it can, but those who are left out of EI or who exhaust their EI benefits show up soon after as a bump in provincial social assistance caseloads. Too often those workers find themselves essentially further marginalized and stuck in residual welfare programs that do little to truly support them in rejoining the workforce. On this slide, we had the social assistance caseloads for 3 different provinces in Canada, and the year-over-year changes to the caseloads from January 2020 to January 2021. So kind of during the pre-pandemic through to the big portion of when CERB was offered, and then 4 months thereafter. You'll notice that the 2 provinces, Ontario and Alberta, on the top really bucked the historical trend by managing to actually significantly cut their social assistance caseloads in the middle of a deep recession. But what explains the difference, for example, with BC on the bottom and the other 2? Well, only BC actually exempted federal CERB payments from provincial clawback rules in their social assistance programs. And this was actually, to my mind at least, the better model to follow. It let the poorest people in BC weather the storm of the pandemic and recession without losing the in-kind programs like prescription drug coverage, priority for affordable housing and childcare that are tied to social assistance receipt and often can't easily be replaced, even with a few more dollars in earnings or income support. In short, we should be thinking about income security as part of economic security. And that means it has to not only include sufficient income, but also a bit of a cushion in a form of savings and sufficient goods and services. So challenge number 3 is about how the administrative capacity of the state has been predetermining in many respects how income security policy is designed and delivered here in Canada. You were looking at a diagram, and believe it or not, this is a simplified version of the diagram of the processing system for the employment insurance program. And in March 2020, this is a system that collapsed under the weight of demand. It is a system that relies on IT infrastructure that is outdated. Some components are 50 years old, written in a language not readily or quickly changed by modern specialists. And governments have also repeatedly avoided spending on upgrades or replacements, not wanting to be seen to be wasting taxpayer money. It's a system as well that has 260 separate rules to avoid stacking of benefits and other forms of complexity. Why? Because the whole emphasis really is about taking care to ensure that claimants receive only what they are entitled to and not a penny more. That complexity that is now essentially hard-coded has come in incrementally over the last 25 years or so. And it's about making sure that systems are not paying more in benefits than the program collects in premiums and avoiding increases to premiums. And that outdated IT and internal complexity of the system together meant that it would have taken months in the spring of 2020 to sort through the initial wave of applications. Hardly appropriate given the depth and spread of the crisis. In the first 10 days of the first pandemic benefits going live, that was the emergency benefit, the federal government had to process and ended up successfully paying out 3 times as many claims for income support as they would normally handle across all benefit types in employment insurance over the course of an entire year. So the only way to square that circle was to really radically change and simplify the benefit design. So they implemented a uniform and low entrance standard, simple ID check, and self-assessment and attestation instead of paperwork to prove recent work history and the reason for job separation. So this flipped a lot of the income support programming on its head by saying, trust now, verify later, instead of verify first and then trust. And in the thick of it, a lot of observers wondered if this trust but verify approach might be a model for how to deliver income security moving forward. One observer noted at the time, and I'll quote here, looking ahead, could trust but verify be a useful principle for reforms to income support in the post-COVID-19 period? My answer is a cautious and conditional yes. One reason why trust but verify could be implemented during COVID is that the benefit amounts and conditions for CERB have been relatively simple, with the acknowledged trade-off that the flat earnings disregard creates a potential work disincentive. That was what I wrote actually back in the summer of 2020. But as we've seen since then, income support programs built on the principle of trust but verify will still come into conflict with the usual ways of handling the verify part. Which brings me to the next part of this saga. It's like an episode of Star Wars, the revenge of the program integrity branch. And in this part of the series, the compliance and collections functions that are more familiar to the tax agency continue to work their way through reviews of pandemic benefit applications. Some of these will have been knowingly and deliberately fraudulent. That's true, that did happen, but based on historical trends, very few and certainly not all applicants for help were committing fraud. So in this brave new approach of trust but verify, we ought to have, as one observer put it, concerns about whether the tax agency will be transparent and clear in how those benefit reviews are conducted and what forms of evidence served recipients will be expected to produce to retain their benefits and avoid penalties at tax time later. That was also me at the time. And in fact, many here today who are on this webinar will probably remember the pivot that took place from generous and easy to access benefits to fairly ill-timed and frightening so-called education letters, and finally admissions of errors and how program rules have been communicated, leading to confusion among applicants, and finally a need for a remissions order to suspend repayments. Careful observers will also have noted the general trends since then. The last phases of the pandemic income supports, in the temporary dental care benefit that is about to be launched, that there's been a trend towards more front-end conditions, including the need to file a personal tax return in order to receive income assistance, even outside of the tax system. So to our European colleagues who have mostly done away with the need to file self-assessed returns, this might sound a little crazy. Why would you need somebody to file an annual tax return to get access to income security programs? But this is a real challenge of designing income support to piggyback on a tax and transfer system that still relies on annual self-assessed returns. Let me just finish off with two final slides. So at the same time that governments have hampered themselves by decades of inattention to their own administrative capacity, they also seem to be faced with competing public and political expectations to design income security programs that can provide timely support that is simple to access, and at the same time, to ensure programs are run in a way to only pay those who are so-called deserving of help. In this context, trust but verify has not, in the end, resulted in timely or procedurally simple outcomes for those program users flagged as potentially undeserving. In fact, there are still multiple cases working their way through tribunals and courts with final outcomes as yet unknown. As the judge in one recent case noted, even when benefit applicants are afforded opportunities to provide additional support, additional information as part of the verification process, the information is not always considered by government officers, and benefit applicants may face an information asymmetry in not knowing the case that they had to meet. This kind of information asymmetry works well when you're trying to catch out tax cheats, but it works less well for policy effectiveness and user-centered design when what you're trying to do is deliver income security benefits to people who have experienced an income shock. I did promise to include examples of forward-looking innovation that came out of the pandemic experience, and so let me end with those two. The first is that the federal government seems to finally have acknowledged the need to invest in administrative capacity, the back-end systems that run income security. And recent budgets have earmarked significant amounts to revamp information management and IT systems. And this was reiterated again, actually, in yesterday's mini budget. Likewise, the serious and whole of government effort seems to finally be in place to address Canada's lack of detailed and real-time payroll information that many countries were able to take for granted and make ready use of in running their income support programs. This isn't sexy stuff, but this is the foundation that underpins and permits a much wider range of creative, responsive, and user-centered program options to come. And finally, the other innovation I'd like to highlight is actually, I think, a meaningful, potentially meaningful pivot in policy that was buried in yesterday's mini budget. I think we might have seen the start of a path forward to dealing with the current constraints on administrative capacity while still delivering income support that is non-stigmatizing and simpler to access. The federal government announced that as of July 2023, low-wage workers entitled to the Canada Workers Benefit will automatically get half their benefit during the year as they earn wages and self-employment income, instead of as a year-end lump sum paid after the fact. So this means that the program can provide more income stability when other income sources fluctuate month over month, which actually seems to be the case for as many as 30% of us in Canada, particularly those with low and modest incomes. It means that the participation incentive that might be hoped for in the CWB design might actually arrive in a timely and hopefully more effective way. And real-time delivery also opens new opportunities for integration of this benefit with things like temporary insurance and EI. There's an awful lot more to do in terms of the reforms to this benefit, but this is a really interesting and I think promising part of the policy challenge announced yesterday, which is essentially a principle of let people keep the money. As I understand it, the plan for the redesigned Canada Workers Benefit is that the reconciliation of the balance on the 50% of benefits payable for the end of the year will not result in a client having to repay money that they received and already used. So I think this is a new and potentially important way to reconcile that tension between trust and verify. And it's happening in a program that is agnostic about whether the paid work was performed as an employee, a gig worker, or in self-employment. There are still a lot of important gendered and intersectional considerations, but I see this actually as an important innovation in income security policy. I mean, how radical an idea is that, right? To just tell people that they can actually have money, in terms of improving income security, making sure that people can collect the benefits they are entitled to and retain them, may be meaningful. Thank you.
Thank you, Jennifer. I always appreciate your attention to detail, to the actual workings of policy to draw broader lessons going forward. And I think that was a real tour de force, emphasizing the importance of design and delivery. The fact that we live in a federation in which provinces can undo innovations at the federal level or innovations that take a long time to percolate up to the federal level is an important point. And to stress how important, and I think this came out a little bit in Robert's presentation as well, how just sort of that machinery that we have in place can actually drive the whole policy process. So delivery is not something that can be abstracted from in policy design. A good deal to think about. The questions are rolling in, and I encourage participants in this session to reflect on what you've heard, and feel free to put your questions in the Q&A, and we will take as many of those as we can. My understanding is that we are slated to end at 1/2 the hour, but that we have another 10 or 15 minutes after that if we want to keep going. So to stimulate the conversation, I think I'd just like to invite a bit of a conversation between the three of you. And I would like to do that in a very open-ended way and allow you to define that. Reflecting on the presentations on the others, what do you see as sort of important insights or innovations for your country, or what's a lesson that you take away from that we should emphasize to stimulate policy learning? You can see I'm just trying to be vague and general here, but maybe we can go in reverse order. You've heard a scoping of the international scene in terms of inequality and redistribution. You've seen a sort of very interesting and well-structured presentation about the history and the state of the United Kingdom, which has had a really interesting go of it in the last 6 months as well. Jennifer, what are you taking away from that for Canadian policymakers, trying to speak to the community that's watching us right now?
Yeah, it's a great question. So I guess the first thing that struck me was that, and I just had to double check this with the IMF fiscal policy database, I was surprised to find out that actually Canada spent less as a share of GDP than either the UK or US in terms of its pandemic response. And yet we are kind of all in a shared boat, as it were, in grappling with what seems to be at least politically dominating the discussion around, affordability and all the rest of it, namely inflation. So it's sort of interesting to see. It's not really clear that what we did or spent as countries then is necessarily determining the experience that we are having right now in terms of affordability. The other thing I guess I would say is that the UK and the US in some respects are kind of interesting counterfactuals to how Canada's policy response could have been designed and delivered. I think we heard Robert talk about a lot of the big challenges to benefit consolidation through universal credit. And certainly that has come out in terms of some of the research that I've seen. And I think in the US we saw sort of this sort of one shot, but everybody gets it stimulus approach, which probably didn't do much in terms of redistribution, but kind of raised some of the same challenges that we're seeing in Canada vis-a-vis the capacity, right, of the IRS to deliver that in a timely and sort of targeted way. Maybe I'll keep it there for now.
That's fair, but do you think the fact that our spending was a little bit lower, is that maybe a mark of more efficiently, better targeted, better done things during the pandemic? Or are you suggesting that there could have been room to even do more?
Look, I would say that one thing that all of our countries, it sounds like all of our countries did, was that we were kind of hasty, flexible, yes, and incredibly generous when it came to employers, the support that they got. But perhaps actually Canada ended up having a very different approach when it came to the workers' side. What's interesting, and I need to do some more thinking about this, is that it seems in some respects our labor market has recovered more completely, but I'm not entirely sure kind of to which policy choices to attribute that. Well
put. Robert, can I turn to you? So obviously my question is just sort of meant to give you a platform, but if there's something that's an important takeaway for you that you'd like to highlight for everybody participating in this, certainly appreciate hearing your views.
One thing is just how much this stuff matters. I mean, I'm almost so struck by pictures like the ones that Janet was showing in part of her talk about, just how important this area of policy is in actually shaping the distribution of living standards in different countries and how much this varies. I think it's good to be reminded of that, just how much this matters. But I suppose the other sense in which I was thinking just how much all this matters is some of the operational issues that Jennifer was talking about. And I didn't talk about those much at all in my own talk, but they really do resonate a lot with some of the UK experience about how, not getting that side of things right can just completely undermine what might otherwise be a really good idea in terms of a policy reform. And we've had this with, there's a couple of great examples from the UK that are very much along those lines. So with the major reform that we've had going on is this thing that we call universal credit, which is really it's not actually a universal payment at all, but what it is an attempt to integrate all of our various means tested elements of support into a single thing. And in many ways, this is a very good idea, I think, for reasons that I don't need to go into, but a lot of it's run into so many problems as it's been rolled out. And a lot of them are really just to do with probably things that people thought were innocuous, like decisions about how it's going to be paid and when it's going to be paid and at what frequency. And there's something that's become known as the 5-week wait that's been built into this new payment, where people don't actually get it for 5 weeks. They don't get the first payment for 5 weeks after they apply, which, when you just draw a kind of standard picture of entitlement against income, you're not going to see that. But it's what has caused a huge amount of strife, actually, and tales of hardship in reality as this thing has been rolled out. And it has contributed, I think, to a significant degree to just undermining the whole reputation of the whole project. And then people get confused about what exactly it is that's causing the problems. They don't necessarily distinguish between the fact that maybe it was a good idea in principle, but in practice it's been botched a bit. And the other thing I would say, perhaps on the plus side, is that one good thing about universal credit is that it went hand in hand with essentially a much greater scope for being able to apply online. Now that creates its own issues because of inequalities of digital access and things, but during the pandemic, that made a massive difference to the ability to quickly deliver something like 1 million extra claims in like 2 weeks during the first lockdown. So, there's positive, negative there, but either way, it's critical. And just one more example right now with the cost of living crisis, we have a real problem because we increase benefit rates once a year in line with inflation, and we do it in line with a lagged measure of inflation. So every April, they go up in line with the measure of inflation to the previous September. So when in the winter of 2021, basically from October and November, inflation started to take off, that didn't even get reflected in the April 2022 benefit uprating. people have to wait till April 2023. And in fact, because inflation hasn't really come down again yet, they're probably going to have to wait till at least April 2024 before the sort of real rates of benefits catch up. Whereas if we had some way of uprating these things in a timely way and using more up-to-date information, that would make a huge difference to many of the poorest people. And again, it looks like a little operational technical thing, but it's not if you're getting that money.
Well, it just sort of reemphasizes that Jennifer, I think, was making, that these little operational things, as you call them, matter. But just to push on that a little bit, is that just a reflection of legacy? Maybe that didn't matter so much in an era of stable inflation, and we just haven't caught up in our thinking, or is there something more to it than that?
So it certainly hasn't mattered for like 20 years because we've had such low and stable inflation. So people have forgotten about the problem. You can go back to parliamentary debates in the 70s and 80s when we did have very high rates of inflation. And people were talking then about, why on earth can we not increase benefits in a more timely way? And when it was because of genuine administrative, you wouldn't believe some of the stuff that is still done by hand, apparently, in kind of benefit offices when they're doing these calculations. So it was kind of, it traditionally was a genuine sort of technical constraint that was then forgotten about. The irony is that with universal credit and the way it is done in a much more sort of modern computer system kind of way, you can change benefit rates in a much more timely fashion. And so we've sort of missed the opportunity that actually we had, I think probably because we'd been used to low and stable inflation, so we hadn't thought about it.
It's partly our mindset and the capacity to think forward. Thank you. Janet, can I give you the floor? How do you reflect upon what you've heard from Canada and the UK, or for that matter, any other country that you're so well versed in?
There's so much to think about. I just jotted a few little things that I just think are worth pointing out. Rob, you had said something, that the graphs that I show are they do sort of wake you up at the cross-national variation. I just want to say what I think all of you know, and probably many in the audience know as well. National policies matter, and they matter a lot. I mean, whether they're national or subnational, we hear a lot of the discourse about rising inequality, and people tend to pull up transnational forces and causes. It's globalization, it's neoliberalism, it's the rise of technology. That does almost nothing to explain the patterns that we see both across countries and, over time. It doesn't explain why France and Germany look so different and why, Norway and Iceland look very different. So these national policies are enormously powerful. And I think looking for these universal grand causes has really taken some of the inequality discussion in the wrong direction. I just wanted to say also, reflecting, Jennifer, your presentation, it's kind of depressing, frankly, all this talk about, policy. The delivery mechanisms are absolutely crucial. Of course, it's not part of what I talked about today. But I do think about this a lot. I've done a lot of work comparing social welfare, both policies and outcomes across the 50 US states. And we also see that the delivery mechanisms also matter. The street level bureaucracy matters a huge amount. We have a long history in the US of designing not so much the unemployment insurance, but the social assistance, designing it to discourage take up at all costs, through making people go through incredible administrative barriers. Stigmatization, public shaming, and where you see some remarkable things, just briefly, is after the so-called welfare reform in the United States in 1996, a big cutback and the removal of the entitlement status from the national law. We pushed a lot of the social policy, down to the states, and we saw, first of all, a huge amount of variation across the states, and a lot of it isn't exactly this. We even see variation across the states in the take-up of programs that are entirely federal in their rulemaking, because of how many lines you have. If you go get public assistance in some states, they hand you an application for food stamps, American program, and in other states they don't, and on it goes. We also know that after 1996, almost 80% of the welfare rolls the families were removed from the rolls, and in most of the research, especially qualitative, shows that people just walked away in droves. It was just impossible. So it's kind of, anyway, the very last thing I just want to say briefly is, of course, I should have said that, Miles, thank you for reminding me. Obviously, my story ended before COVID, partly just because that's when we had the data. We're all absolutely dying for the next rounds of data to come in. There's a few years of delay. And I think the story of COVID and social policy is going to take a decade, first of all, the pandemic's not over really, but very similarly in the US, this just extraordinary outpouring of aid that we just couldn't believe our eyes, and especially when the Biden administration came in, they were giddy over the regime change. Imagine that. And, just incredible amount of diverse aid, everything, paid leave, sick leave, cash transfers, child benefits, eviction protection, things we've never seen in our lives. And progressives were just giddy also with, look, a lot of talk about making the child benefits permanent, and it's all gone, virtually all gone already. And it's going to be, but it's an incredible experiment that we saw. And the child poverty rates, Miles, as you said, they absolutely, they fell so sharply in the US. And what is it, are things going to be sticky? It's hard to tell, because my sense is it's all going to be reversed, and not just the policy, but the outcomes.
Okay. Actually, your last comments touch on a couple of questions, so I'm anxious to get to them, but I found very interesting your discussion of design meant really to discourage take up, and that whole framing of income protection around disincentive issues we saw in Robert's discussion as well. I think there's still going to be a conversation to be had between Jennifer's trust and verify, as she concluded her presentation, her trust and verify, and the old disincentive story. But I think I'm going to read just some of the questions that have come in verbatim, because they are so well put. And the first is one by Sherry Torjman. Let me read it to you. And Janet, it picks up on your theme of market income and income after taxes and transfers. Sherry asks, our policy efforts tend to focus on redistribution after the fact. Should we be focusing more of our policy initiatives on reducing inequality in and/or improving market income? If so, what might be some effective policy responses? So I think this is a question about so-called inclusive growth. How can we make the market work to the relative advantage of the relatively disadvantaged, so that there's less heavy lifting to do from the tax and transfer system? And maybe I compare this with a question from Keith, which is sort of speaking broadly to the same issues. In what ways are current labor shortages changing the agenda for reform in income protection? I suppose we can have a discussion about whether there are labor shortages. But the point is, can you reflect on how the market works and how we can make it work better for income protection? Is that fair? Who would like to go? Robert, why don't I throw that to you, since you haven't had a chance to go first, then we'll go to Jennifer and Janet. But of course, if you just want to pass, just give me a wave and we'll keep moving on. Robert, can I give you the floor to you?
It's a great question. Not long ago, one of the, I think it was the leader of the opposition at the time in the election, started using the phrase of pre-distribution to capture this concept, rather than just redistribution. Yeah, of course, this often comes up. I tend to think of, welfare or income protection is normally at the end, in the end, is a sort of patch that you're applying over a problem that you haven't found a better way of addressing, is, I think, often a good way of thinking about it. And if we could address it in some other way, we probably would. And I think there's a related issue that, compensation in a financial sense for losing your job, lack of labor market opportunity more broadly, often isn't real compensation. I mean, it's something. Yeah, people, the financial side of things matters to people. But I think unions sometimes refer to this as sort of burial insurance. If you lose your job, that means more than just losing the money that you got from your job. It's related to your whole esteem and feeling of where you are in society and many other things. So I think just sort of leaning on compensation like lazily and not doing anything else is partly a bad idea for that reason too. I mean, on the specifics, yeah. So I mean, one thing is it's hard, right? It's hard. Redistribution is hard, and it's also probably also harder to take credit for politically as well, because it's sort of harder to draw a straight line between what you've done and the outcome normally, that compared to just giving money to people. In the UK case, I would say this sort of reflects the main challenge we have. The policy cupboard is quite bare. We have in-work transfers on the one hand, which have been effective, at least on their own terms. And then we have rising minimum wages. That's the other sort of pre-distribution policy that we've been leaning on very heavily. And so far, that seems to have gone okay as well, and that we haven't, like many countries, haven't seen huge negative effects that some people worry about from that, and it has boosted earnings. But other than that, we really are out of ideas. And one thing we have very little of in the UK is in the way of sort of collective bargaining or anything like that, that can strengthen the bargaining position of workers. And that, I think, is something we should probably be thinking about. And that relates to changes in the world of work, which might make that issue harder to tackle as well. So yeah, I won't blather on anymore. There's so much you could say on this. It's a whole seminar, isn't it? But I very much approve of the question. I think it's really important.
It is a seminar. When we speak of labor shortages, for me as an economist, that says excess demand. What happens when there's excess demand? The price goes up, and this is the wage rate. So it seems to me, in some sense, excess demand is not a bad thing if you're interested in inclusive growth. But that, as you suggested, sort of lends a whole policy angle to industrial relations. Jennifer brought up the issue of collective bargaining. So maybe I can turn the question to you, Jennifer. What's inclusive growth? How do we enhance it? And what do you see as the challenges?
Oh my goodness. Oh, please don't make me define inclusive growth. Okay, so.
Okay, do it. It's okay.
Okay. But maybe if I kind of come back to that question around sort of redistribution versus pre-distribution.
That's all I mean. That's all I mean.
Okay. Terrific. I guess I'll say two things then. So yes, the language around pre-distribution, I think, is starting to be used here as well in Canada to some extent. Certainly the current government nationally is very keen to talk about the role, for example, of public spending on childcare, right, as a form of intervention that should, fulfill kind of that pre-distribution model. But I think that there's still other areas, for example, delivery of public education, of healthcare services, right, and basically just a broader recognition of what are the range of social risks that can actually put people in situations of income precarity. I don't think that we've necessarily grappled with those yet. Miles, to your point about labor shortages and how that ought to have an impact in terms of the wage rate, I have been tracking and really surprised to see, yes, wages in Canada have gone up a bit, but certainly not to the extent that you might expect given the reported labor shortages or excess demand for labor. And it does always strike me as interesting how some supposedly pro-market voices are actually quite anti-market when it comes to the forces on raising wages. But I guess the last point I would just raise is this sort of residual issue of in a world of if there are labor shortages, if there is greater demand for pre-distribution, as well as pressure on the redistributive mechanisms that we do have, are we doing enough to actually ensure that the population is adequately covered through our mechanisms of collective insurance, or are we permitting essentially too many escape clauses, right, for both the employers as well as individuals who have decided for whatever reason to opt out, as it were?
Fair enough. Let me just engage you a bit, Jennifer, because there's another question that came in that's related to this conversation, I think. But first, I do want to say how it's, I don't know if hypocritical is the right word, but if you believe in markets, you sort of believe in sort of efficient outcomes and you're letting prices adjust. It's interesting how this conversation sort of goes back and forth. I'm not even going to get into temporary foreign workers as something that really introduces a certain policy incoherence if you were interested in inclusive growth. But there is, I think, an interesting policy development that you alluded to earlier in your presentation. The Minister of Finance, the Deputy Prime Minister Freeland, introduced an innovation to the Canada Workers Benefit, which is our version for the Americans in the room of the EITC. And I think there's a similar program in the UK. The government is trying to move that program into real-time delivery. The struggle it has, of course, is it's delivered through a tax system based upon your reporting in a previous year, but it's moving to quarterly payments. Interestingly enough, it didn't enhance the program any further, although there have been a number of enhancements. And Lee Stevens asks, what are your thoughts on the Maytree proposal for the Canada Working Age Supplement? If I've got it right, I think by working age supplement, he means the Canada Workers Benefit. And the Maytree proposal has to do, I think, if I recall, introducing a non-conditional component to that. Any thoughts, Jennifer? This is sort of a very innovative policy that needs to grow because the working age group is the one that is falling through the cracks of the poverty safety net. Maytree put forward an interesting proposal in time for the budget consultations. Where do we go?
So I am not going to be able to comment specifically on the Maytree proposal, only because it is here on my desk as part of my to read pile, and I feel like I ought to do it justice by engaging more
Fair enough
with it. Here's what I would say. Yes, there are multiple gaps in terms of the income support for working age adults. The idea of having some kind of so right now, of course, CWB is conditional on having some paid work income, whether that's through employment or self-employment. The idea of essentially adding a floor that would cover people who have zero in that paid work, certainly bears consideration. But there's the irreducible issue of the interaction with the existing other forms of support that people receive and may be reliant on, namely provincial social assistance. And we also have this proposal for a Canada Disability Benefit, and an important share of that working age population that has low or no work income would actually fall into that population. And I wonder whether we ought to pursue the proposed disability benefit first and see what traction we can get with that before thinking about expanding the workers' benefit in that way. Like, in other words, would we have addressed the policy solution? Would we have found a policy solution through another mechanism? But as I say, I feel like I ought to more seriously engage with the Maytree proposal before commenting more substantively on that.
Thank you for that. A lot will hinge, I suppose, on how we define a disability in that legislation when it does finally work its way through Parliament, if I've got that right. Maybe I can turn to Robert and Janet to speak to another question from Kevin Dick. He says, did other OECD countries have something similar to the Canada Emergency Response Benefit? Was it more or less effective? What can Canada learn from other countries? As Jennifer alluded to, the Canadian federal government spent a lot of money propping up businesses and small businesses. The biggest expenditure in the pandemic envelope. It would be the equivalent to the payroll protection plan in the United States. But we also spent a good deal of money directly to individuals, not universal, but subject to some income cutoff in just a flat payment. What was the experience in the other countries of an almost unconditional payment? Robert, can you bring us up to date on the UK experience?
As I mentioned, partly because we had such an inadequate safety net for dealing with a large scale kind of lack of jobs, we implemented from scratch a furlough scheme. So that meant up to a fairly high cap that basically people could be paid, or the government would subsidize 80% of people's earnings while they were furloughed from their firm. So sort of the dual goal of that was to maintain the match between people and their jobs so that when the economy restarted, things could get going more seamlessly, and income protection as well. So that's what we did. So really, I mean, pretty crude, just 80% for everyone. And as time went on, I think there was an increasing case, or would have been an increasing case, for tailoring this more, so particularly in the second and third lockdowns and around those times, there started to be quite a bit of variation with, some sectors still locked down, but other sectors very much able to, get back to something closer to normal. But there was never any tweak introduced to vary this scheme by sector or anything like that. So my overall take on it is that given where we were, it was hard to see what else we could do. And we could have gone down the US route of just allowing mass job severance and dealing with the problem through unemployment insurance. I personally, I think there were good reasons not to do that and to have some sort of match preservation role behind what we were doing. But perhaps, I guess it's an area where I feel like we could learn maybe in the future and trying to refine had we known at the start, frankly, that we would still have a furlough scheme in place 18 months from that point and that the nightmare would be continuing, I think we'd have put in more work early on to refine the scheme for later. And we didn't do that. And we probably should do that next time.
Thanks, Robert. We're running short on time, but Janet, I hope you can just take a minute to respond, if you like, on the US case, a country that, of course, in terms of policy spillovers, is very important for us in Canada.
First of all, let me just say, on the story of COVID relief, and again, as I said, it's still unfolding. I think one of the views in the US was that we allowed way too much job severance relative to models that we could see in place in other countries. And, that was a very sort of American idea, let people lose their jobs and then we'll sort of see what happens. Not that the aid wasn't extensive, but I just want to go way back to someone else's question, if I could briefly. The term pre-distribution, we've imported that in the United States. And the idea and the discussion about reshaping earnings, essentially, I can't say that it's in the public discourse, but it's a big discussion now. And I recently reviewed the literature on this, actually, in the cross-national context, and the findings were very strong prior to COVID. Let's leave aside sort of unusual labor demand. What the correlation between the level of the minimum wage and the share of low-wage workers is enormously strong across countries, as is. So in other words, if you just do a scatter plot of the minimum wage as a share of median earnings and then the share of low-wage workers less than 2/3 of the median, it's an absolute straight line. Same thing with union coverage, not membership, but union coverage. Those two are enormously powerful. And the third thing that we came up with in our literature review that's really important for not just reducing wage dispersion, but especially pulling up the bottom, is the regulation of working time, something I've worked on a lot. It's totally off the radar in the United States, forbidding 0-hour contracts, requiring, as the EU does, pay parity between part-time and full-time workers. There's so many things about working time. And the UK and Canada are moving ahead with these kinds of worker protection. So I know it's almost out of time, but I'm gratified to see in scholarship in the policy world, people are talking about both more and more, redistribution and pre-distribution together. Tony Atkinson, who many of us know, a very famous inequality scholar, just before he passed away, sadly, a few years ago, wrote a huge book on inequality.
I remember that book. Yeah, thanks very much, Jen. That was a very provocative book. I just want to apologize to the people who did have questions in the Q&A that we weren't able to get to. Obviously, this has been a very stimulating panel for me and for the others. In spite of the letter J appearing in all of your names, there's been remarkable diversity. So I'm really pleased to have been engaged with you. And on behalf of Margaret Biggs, Keith Banting, and everyone involved in the organization of the Munk Queens conference, I thank you very much. And we look forward to continuing the conversation in some other way. And thank you, everyone, for participating and engaging in this. And Margaret, if I give the floor over to you for a final word, that would be great.
Super. Thank you very much, Miles. A huge thank you to you, Miles, as our moderator and the panelists, Janet, Robert, and Jennifer. This has been actually a masterclass and very engaging, thought-provoking discussion on a really important and topical question in Canada and all our countries. I wish we had more time. There were questions in the chat box, and also people asked if the slides and the videos would be made available, and the answer to that is yes. The presentations and the video from this session will be posted on the conference website. I just want to flag for all of you that the next seminar, the next virtual policy seminar in this series will be on Monday. That's November the 7th. It's on the topic of immigration, which will be very topical, particularly for those in Canada, because there's some recent announcements around immigration levels in Canada. The speakers for this session will be Martin Roos from the European University Institute and Rupa Banerjee from Toronto Metropolitan University. And you can register online for this and other sessions in the series. Just go to the conference website on the Munk School of Global Affairs and Public Policy's website. Okay. So before closing, I would really like to thank again the panel here, and all of the participants, and also Employment and Social Development Canada and Immigration and Refugee Citizenship Canada for their generous support, which has allowed us to bring these leading international and Canadian experts together in a public forum. Thank you all very much. See you on Monday, I hope.